After months of coronavirus, Americans now know how the epidemic has affected the economy. Broken supply chains, record unemployment, and failing small businesses. All of these things threaten to send the U.S. into a deep, prolonged recession. However, the economy faces another threat as well, and this lurks on the balance sheets of the big banks, and it could be cataclysmic. Imagine waking up one morning to find that the financial sector had collapsed on top of all the uncertainties surrounding the pandemic. You might think a crisis like this is unlikely since you remember the 2008 crash so clearly. Still, banks didn't learn from that disaster, and new laws meant to keep them from taking on too much risk haven't worked. Thus, we're at the edge of another crash, less in kind than in degree, and this one could be worse. So what to do about this? Well, let's find out in today's video. Make sure to watch this video till the end. So banks around the world are bracing themselves for tougher economic conditions and the possibility of a global recession in 2023. As in the past, they will try to batten down the hatches and keep costs as low as possible during this time of economic turmoil. However, smart firms will ensure that they make the investments that will put them in a strong position for the upturn to come in the future if they're smart enough to make them. It is important to note that banks are susceptible to a range of risks. This can be divided into three categories: credit risk, loans and other assets that go bad and cease to perform; liquidity risk, withdrawals that exceed available funds; and interest rate risk. A rising interest rate reduces the value of bonds held by a bank and forces it to pay a higher interest rate on its deposits than it gets on its loans if interest rates rise. In many cases, the cause of banking problems can be traced to a decrease in the value of the assets of the banks. It is possible for asset values to decline. For example, if there is a collapse in the price of real estate, or if there is an increase in the number of bankruptcies in the non-financial sector. Or, there's also the chance that a government may stop paying its obligations, thereby causing a sharp decline in the value of the bonds that banks hold in their portfolios to occur. When asset values drop significantly, a bank may end up with a position where its liabilities exceed its assets at a point when they have negative capital, meaning that the bank is insolvent or has negative capital. Alternatively, the bank may still have some capital on hand, but not the minimum amount required by the regulatory authorities. This is called a technical insolvency by some. In addition to this, banks can also face problems if they are faced with too many liabilities coming due at the same time, and they don't have enough cash or other assets that can be easily converted into cash to satisfy these liabilities when they ultimately come due. There are many reasons why this can happen. For example, if many depositors want to withdraw their deposits at the same time, depositor run on the bank. Also, it is possible for the bank to run out of money if the bank's borrowers wish to withdraw their money from the bank and they do not have enough cash to do so. As a matter of fact, there is a possibility that the bank will become illiquid. However, it is important to note that illiquidity and insolvency are two different things. Suppose, for example, a bank is solvent but illiquid, meaning that it has an adequate amount of capital but it does not have adequate liquidity on its hands. Nevertheless, it is important to keep in mind that insolvency and illiquidity often go hand in hand. There are often times when there is a decline in the value of the bank's assets, which causes depositors and other borrowers of the bank to feel uneasy and demand their money back, causing the bank to have more problems. In a systemic banking crisis, many banks in a country are having serious solvency or liquidity problems at the same time, either because they are all subjected to the same external shock at the same time, or because failures in one bank or a group of banks spread to other banks within the system. A systemic banking crisis is more precisely a situation where a country's corporate and financial sectors experience an abundance of defaults and deal with great difficulties paying all of their debts on time, as well as having difficulties resolving their financial problems. This results in a sharp rise in non-performing loans, and as a result, banks are forced to exhaust all or most of the aggregate capital within their system. It may be the case that this situation is accompanied by falling asset prices, such as equity and real estate prices, after run-ups prior to the crisis, sharp rises in real interest rates, as well as a slowdown or reversal of capital flows in the wake of the crisis. There are some cases where the crisis is triggered by depositors' runs on the banks, while there are some cases where it is a general recognition that systemically important financial institutions have a problem. There is no doubt that systemic banking crises can be very damaging to a financial institution. In most cases, the effects of these policies lead to deep recessions and sharp swings in the current account. In some cases, crises have been found to be contagious and have spread quickly from countries that appear to have no obvious vulnerabilities to other countries. A number of factors have contributed to the development of banking crises, including unsustainable macroeconomic policies, such as large current account deficits and unsustainable public debt, excessive credit booms, large capital inflows, and fragile balance sheets, along with policy paralysis caused by various political and economic constraints. In fact, in many banking crises, currency and maturity mismatches were a salient feature, while in others, off-balance sheet operations of the banking sector were the major cause of the crisis. For example, a global database of banking crises was first compiled by Caprio and Klingenbiel, 1996. It identifies 147 systemic banking crises, of which 13 are borderline events, from 1970 to 2011. In addition, it outlines 218 currency crises, defined as a nominal depreciation of a currency relative to the US dollar of at least 30% and a rate of depreciation of at least 10% higher than the rate of depreciation the previous year, and 66 sovereign debt crises, defined by the defaulting government on its debts to private creditors, over the same period. There is detailed information in the database regarding the policy responses to resolve crises in the different countries of the world. Studies based on this dataset, such as CHEC and SHAKE 2010, have found that it is very difficult to predict banking crises consistently, but there are some variables, such as those reflecting high leverage and rapid credit growth, that indicate a greater likelihood of a crisis in the future. It was found in both the report and the paper that crisis-hit countries had a more stringent definition of minimum capital, a lower actual capital ratio, were less strict in their regulatory treatment of bad loans and loan losses, and faced fewer restrictions on the activities of non-bank institutions. Although they had tighter disclosure requirements, they did not offer the private sector any incentives to monitor banks' risks as effectively as they should. It is safe to say, however, that regulation and supervision have seen only gradual changes during the global financial crisis. In some cases, such as increased capital ratios and the strengthening of resolution regimes, some steps have been taken in the right direction, making regulation in crisis countries closer to regulation in non-crisis countries. In the meantime, as a result of some of the policy interventions during the crisis, there have been a weakening of private sector incentives to monitor banks' risks as well. Based on results of the analysis, it is evident that there is room for strengthening regulation and supervision, as well as incentives for the private sector to monitor risk-taking. So, if we can manage to get through the rest of the year without waking up to a collapse in the financial system, we must find a way to prevent the big banks from going all in on bets that they can ill afford to lose. It is inevitable that their luck and ours will run out at some point in the future. What do you think? Tell us in the comments. And that's it for today's video. We hope you liked the video. Make sure to give it a thumbs up, and for more such videos, subscribe to the channel. And don't forget to press that bell icon. And we'll see you guys in the next one. Until then, peace.